Welcome back to Startup Accounting 101. It's a video series for founders to understand accounting fundamentals for running a business. We are moving through the financial projections templates and it is available for free from score.org. Just go to the template gallery and download the file. I'll have their link in the description below. This video will cover tab 7B, which is the income statement for years 1 to 3. We will be analyzing the income statement growth over 3 years. In the last video, the common size income statement video, we looked at year 1, and we will be using the percentages for analysis. So check out the other video on common size for an overview about that. I will link the video somewhere. So to analyze the projection, we'll have to complete the common size percentages for all 3 years. I only did it for the first year, so I will do that now. So for the second year, I'm just completing the percentages all the way down. And then for year 3, doing the same thing. Okay. All right, so we already see off the bat that the third year, year 3, is unprofitable. Now, no one sets out to project business losses. So we can see, what's happening to make the company unprofitable and what are the different drivers for that. So if we go up here, if we look at the percentages, so obviously the revenue will be 100. And I fixed all of the cost of goods sold to the same amount, per in comparison to revenue. So everything in the financials up to gross margin will be the same in terms of the percentage. And then we see that payroll is a huge driver in the increasing or decreasing of profitability. So after the first year, we see the second year it increases by 10%, and then the year after that, it's 23% compared to the first year. So that's going to be a huge driver. The other expenses are more or less the same percentage-wise here. In fact, it's decreasing. So the total operating expenses it keeps decreasing relative to sales. It decreases about 5% year over year, which is nice. It's just a stable operating expenses. And with the other expenses, it's about the same. So the major driver here is essentially payroll. So now that we've identified, hey, this line item seems to be the issue with our projection, now we can do some scenario planning. Like, we have to make some changes to year 3. And the income statement is tied to all the other tabs, so I'm going to split this up. Split the screen so I can take a look. So let's just go straight to payroll. So we've got payroll over here somewhere. Okay, payroll is over here. And in the third year, we assumed, or we wanted to project out hiring 10 employees for the third year. So why don't we hire less people? So if we, instead of going up to 10 employees, let's go up just to 8. And when we we do that and we go over here, like the percentage, the common size dips quite a bit. Originally it was 69%, now it's 61. If we go down here, we are profitable. Yes, which is what we want to see. Now, if the first year, if we wanted to sort of benchmark the net income, so we have 9% in the first year, and we want to say, hey, the next couple of years, we want to make it also 9%. So another thing we can do is we can increase our sales. Let's make more sales. So if we go to the sales forecast, so there was a growth rate that was estimated. So if we increase the growth rate of sales from year 1 to 2, we increase it from 33% to, let's go, 45%. Ooh, nice. So now on the second year, we have a net income that is 9%. And in the third year, it is 10%. And I'm happy with that. I feel okay. If we go back to payroll, it sort of stabilizes a little bit, the payroll growth. It increases year over year about 5% per year. So I'm fairly happy with this projection. So this income statement projection can now be used as a guide. This is the ideal scenario. Right? It's based on the best estimates, the best information that we have, at this point in time, like today. The business world, we would say this is a budget, right? And throughout the year, your FP&A folks will analyze sort of actuals versus budget. So let's say in the second year, like halfway through the year, if we're not tracking to $1.2 million in sales, might need to make some changes. It's the same for every other line item. Like if any of the cost or the expenses, increase unexpectedly, something happens, you may have to make some tough calls, make some strategic decisions just to make sure that the company stays profitable. And with that, we have reviewed the income statement for years 1 to 3. The next video, we will be looking at the balance sheet. So like and comment if you enjoyed the video, you like my teaching style, you learned something new, and please subscribe, and thanks for watching.